Welcome to the Cannabis Equipment News Podcast.
Hi, I'm David Manti, and welcome to a new episode of the Cannabis Equipment News Podcast. With me today is Darren Gleeman, Managing Partner at MBO Ventures. Thank you very much for joining me today, Darren.
Oh, you're welcome. Thanks for having me here, David. I appreciate it.
Before we get started, please make sure to like, share, and subscribe to the podcast. You can also help us out a lot by leaving the podcast a positive review on whatever platform you use. If you want to email the podcast, you can reach me at david@cannabisequipmentnews.com with email the podcast in the subject line. You can also subscribe to our daily newsletter. Make sure you get it delivered to your inbox first. Darren, I always like to start the episode with a little bit of background. So how was it that you found yourself working in the cannabis industry?
Yeah, so myself, my partners in the industry have been doing ESOPs now for over 25 years. We've structured to over 400 ESOPs, over $22 billion in enterprise value. We've structured the debt of over $7 billion in ESOP debt. So we do in every industry, never looked at cannabis. Usually you look at more mature industries, boring industries. So cannabis, high flying, crazy multiples. So about 2.5 years ago, someone says, "Hey, Darren, what do you think about doing an ESOP in the cannabis space?" I'm like, I don't know. Cannabis is like artificial intelligence robotics. I know the multiples are 4 or 5 times revenue. It probably doesn't make sense to do an ESOP. And they're like, well, those are not the multiples that are going on anymore. And they say, yeah, you're right. And there's also this weird tax regime thing called 280E. And they explained to me what 280E is. And as soon as they explain it to me, my brain starts thinking, oh man, this is crazy. This is a huge opportunity. And I'm not saying anything. At that point, I say, look, there's a humongous arbitrage opportunity, a tax arbitrage opportunity. Let me go out and start acquiring these cannabis firms who are paying this tremendous amount in taxes. We'll use this ESOP structure, which allows all of the employees a broad-based employment, but we get to pay 0 federal tax and 0 state tax forever. That's just a benefit that you're given. And so we look at that, and that's how I get into the space. We place a bid on a company. While we're doing our due diligence, the company can't pay down its current debt. The shareholders start suing each other. It was a huge mess. We get out, and I'm like, you know what? Let's just do what we always do, which is investment banking / advisory. And that's how I got into the cannabis space. From there, I never went directly to any cannabis companies because once I go through the pitch and I explain it, I always get 2 things. Well, why didn't I know about this before if it's so good? And it sounds too good to be true. Always get it. So I need to go through the attorneys and the accounting firms and explain to them how it works. And even when you explain to them, you get people scratching their heads like, I thought I knew what an ESOP was. A lot of people think they do, but they have no idea what it is. So that's really my journey until finally in the month of December, we were able to close 3 ESOP deals in the cannabis. They're the only ones and the first ones that are done. And this year we'll be closing probably about 6 more.
What's an ESOP?
Yeah, that's a good one. An ESOP is just another way for you to sell your company. So with an ESOP, and it's an acronym for Employee Stock Ownership Plan. It was made up, just that name, it's a weird name made up in the 1970s. But really, it's just a structure that's subsidized by the government. And it's a way for you as a business owner to sell your company. You can sell your company to, or any company in the United States, right? They can sell their firm to a private equity firm, like a financial buyer can come in. They can sell it to a strategic buyer like a competitor. And not many people realize that they can sell to their employees. And they sell it to their employees. One of the structures, which is the tax incentivized structure, is this thing called the ESOP. And that's what it is. Just a way to sell your company.
Why is that particularly lucrative to cannabis operators?
Yeah, it's particularly it's lucrative to all industries. It's just that because of 280E and because of the tax regime of 280E, where with 280E, just I'm sure all your listeners know, you get taxed on your gross profit. You cannot deduct any expenses. You can't deduct your salaries. You can't deduct your rent, nothing. So it's a pretty big tax. So what it does is when you sell your company to the employees with this ESOP structure, the company pays no federal taxes in the code. There's no federal tax and no state tax. And if you're paying no taxes, then these deductions don't matter. So in the cannabis space, everyone is talking about 280E. It's the biggest thing because it really impedes your cash flow. You're talking about effective tax rates in the cannabis industry, 60%, 65, 70% is the effective tax rate. In the normal world, the effective tax rate is 40, 45%, still high. But at the normal world of 40, 45%, people are used to that forever. They've been paying that. They're used to it. In the cannabis space, because it's much higher, they're not used to it. They don't want to pay it. It affects their cash flow. So everyone is looking at different ways to get around it, right? Figuring out, can I do this? Can I do this? With the ESOP structure, you're not getting around anything. You're not evading it. You're not getting around it. You're still filing your taxes. You're taking no deductions. You're doing everything you're supposed to do. It's just at the end of the day, the ESOP structure, the ESOP itself is a completely tax-free entity. So that's why with the cannabis space, people really, really want to know what this is like. Think about it. Let's say let's just make a number. You're making a profit, $10 million. And the word we use is EBITDA. That's the fancy investment banking word for profit before taxes, right? So you're making $10 million. Well, as a cannabis firm, you're making $10 million, you're a couple of dispensaries. That means you're probably paying about $6 to $7 million every year in taxes, which is insanity. If you're a regular company making 10 million, you're probably paying about 4.5 million in taxes, still high. Well, if you are owned by the employees with this ESOP structure, there's no taxes. So if you have a profit of 10 million, you now have cash flow of $10 million. So it's a pretty awesome way for you to structure your company.
When you see other ways that people are trying to get around 280E, in your mind, is the ESOP the most, for lack of a better term, legitimate?
Yeah, so the ESOP is the only legitimate way, and you are literally not getting around 280E. You're literally not getting around it. Just to I can jump into the weeds, but it's very boring. But bottom line is you are still filing the same. You're following 280E to the T. Yeah. You are not at all. You're not looking at COGS. Not that there's anything wrong with you. You're not looking at COGS. You're not doing something with 471C with inventory. You're not looking at the nuances and say, well, they kind of mean this. Let's just move it to the line. No. You're very way above the line. You're just following it as Congress intended. So back in 1998, Congress wanted to come up with a completely tax-free company for employee owners, which doesn't exist. There is no company in the United States that's completely tax-free unless they're owned by an ESOP. So in 1998, they want to create this. They write up a bill, and President Clinton signs it into law in 1998, which allowed this structure. And that's only one of the benefits of it, but they allowed this structure. So from 1998 onward, a company owned 100% by the employees, and it sits inside of an S corporation, pays zero federal tax and zero state tax. And it's not because I figured this out of how to do it. No, Congress literally did this, and President Clinton knew exactly what he was doing when he signed it into law. Because right now, you have a Native American tribe, which is not part of the United States. They run tax-free because they're not part. They're actually an independent nation. And that's it. Other than that, ESOPs can run tax-free. Now, I don't know if you know this, but even if you are a 501c3 tax-exempt organization like the American Heart Association, If they went into business, any business, they still pay tax on that business. They don't pay tax on their donations, but if they went to cannabis, they'd have to pay the same exact tax as everybody else.
So, I mean, that makes perfect sense to me. When did you execute the first ESOP in cannabis? Was it this year, 2020, or last year, 2023?
Yeah. So we executed the first three in December of 2023.
So, what has your inbox been like ever since word has kind of started to spread about this possible solution to neutralize 280E?
It's interesting because you still get a group of, it's usually the owners just don't believe it, because they've heard so many things. I got off a phone call with someone a couple of hours ago, and they're like, look, first, the big thing that we all needed to do was go public. Well, that didn't work. And then we had this, like all these things, just nothing works. Is this ESOP structure just another one of these ideas that, now it's going to be great and then it's not going to be great in a year from now? No, the ESOP structure has been around since 1974. We've had a lot of incentives and benefits added on to the ESOP structure, but it's been around for a very long time. So yeah, my calls now are coming in, and most of the calls are, I want to have a conversation about this. Can we do it? What's the size? What's the structure? So yeah, I'm getting tons of it.
So I'm sure you hear this on the call too, but what's the catch?
Yeah, what's the catch? Yeah, exactly. What's the catch? The catch is this. Number one is once you sell the company to the employees via the structure, well, now the Department of Labor, the DOL, governs. They're the governing agency. Not that they're doing anything, but if you have a 401k, the DOL now governs that 401k. So the ESOP structure is under their influence. So they now govern that ESOP structure. That's really the catch to what you have with an ESOP. Now, with an ESOP, let's take an example, right? Let's just say $10 million in net income. What's the value of the company, right? What's the value? That's the key. That's a catch, right? So with an ESOP, there's a legal term called fair market value. That means that the employees to buy this, and by the way, it costs the employees nothing. For the employees to buy this, they cannot pay more than fair market value. No one really knows what fair market value is because the Department of Labor has never gone out and actually codified what they call fair market value. But over the years, over the past, 50 years, pretty much we have an idea, of what fair market value is. So fair market value means we look at the public comparables, public companies. We look at private company sales, and we use an investment banking mathematical formula called the discounted cash flow method. And we put all these things together, and we come up with what we think is the fair market value of the company. We cannot pay a premium. So let's say we think this company is $10 million in net profit, and we say the company's worth $50 million, multiple of 5. Well, there's a trustee that's hired by the employees, right? The company pays for it. And the trustee, they're a fiduciary. That means they're personally liable. The one thing that they need to make sure that the employees do not pay more than fair market value. That's it. They can't allow it. So there's literally a negotiation, like a normal investment banking firm. We're negotiating back and forth with this trustee. We're like, this is the real fair market value. And they may say, well, this is fair market value. And then there's a battle between us trying to figure out what the true fair market value is.
Okay.
The catch, let's say we come up with a fair market value of $45 million. 5 years down the road, the Department of Labor can say the fair market value of that company was not $45 million. It was $44 million. Seriously, that's what they could do. And then the trustee is liable for that personally. So then there could be a lawsuit and there's issues that go on. That would be the catch. That's it. Other than that, there's no, catch. There's no gotcha.
So if the company decides to do an ESOP, the company is valued at $45 million. How do the employees buy into it?
So let's take an example. Let's do a case study, just so you understand. And let's make easier numbers, just so everyone easy. 45 is a hard number, right? Let's say 20 million in profit. I know no one's making that, but let's say 20 million in profit, and that's worth 20 times 5, 100. It's worth 100 million. It's easier numbers. So if a private equity is coming in to buy a $100 million company, I'm about to tell everybody the secret of private equity. I'm not giving you 100 million bucks. This is how I buy your company for $100 million. I give you from my fund's money. My fund has money. So from my fund, I give you $20 million. I then borrow money off of your company's assets or cash flow. Your company, not mine. So I go to a bank, let's say it's JP Morgan, and I say, look, this company is making $20 million a year. Will you lend 60 million, 3 times the 20? And they will for $20 million. So JP Morgan then gives a loan for $60 million, and that goes to the owner. So now remember, the owner has 20 million from the fund, 60 borrowed from their company, that's 80, and the last 20 million is something like, it's called an earnout. And that means as long as your company reaches the numbers that you told me you were going to reach when we're negotiating, you're going to get the $20 million. If you don't reach those numbers, you're not going to get the full 20 million. We're going to have an argument here. That's traditional private equity. With an ESOP, it's structured very similarly, but there is no equity in the deal at all. And again, it costs the employees nothing. So in this example, the company goes out, instead of having a third party like a private equity firm lever up that 60 million, the company borrows the same $60 million from that same company, and they take that 60 million and they give it to the owner. Now the owner has a $60 million. Well, they're owed 100. The last 40 million is called a seller note, and that is an IOU from the company back to the owner. That's how they get the $100 million. That's how that works.
Okay.
Something this is interesting. Again, these benefits, like what is it about an ESOP? Like, well, here's another benefit. Normally, if you take out a loan, anybody takes out a loan in this country for a mortgage, for a business, line of credit, doesn't matter, there's interest. Everyone gets to deduct the interest except cannabis firms because we can't take any deductions. Now, nobody can deduct the actual principal of the loan. I don't know if you know that out there in podcast land, but you can't deduct the actual principal of the loan. Except the only case that you can is if an ESOP is buying the company can take a full deduction of the entire principal of the loan up until the purchase price. So in this example, the company can take a deduction of $100 million, which is huge. $100 million deduction is the equivalent of the government writing you a check for $40 million. Again, I'm incentivizing you to sell to your employees. Now, in the cannabis space, no deductions. Sorry. So in every other industry, that is phenomenal. But in cannabis, we can't take that deduction. But it is just something, worth noting, for the podcast, because it's pretty crazy. It's pretty impressive.
Is part of the hesitance that people are hoping 280E goes away?
Yeah, that is part of, part of the hesitance is that, and then part of it is also, depending on the state and depending on where you are, it doesn't make sense. Let me explain. With an ESOP, right, another benefit that you have, right, there's a lot of benefits because the government, let me explain to you, the government, right, wants employees to become owners because in our country, capitalism works. It really does work. But in order to really gain some nice amounts of money, you need to own a company. You need to own equity. And the government, they actually know this, right? And they've known this for a long time. So how do we get a regular worker to get equity? Well, because as a business owner, am I going to sell to my employees? I have no money. I can't get as much money as the private equity guys or strategic buyer. So the government came up with all of these incentives to incentivize you to actually sell to your employees. And I forgot where I was going. What was the question?
So, no, you were saying that in some states it doesn't make sense.
Oh, yeah. So one of the advantages, right? One of the advantages is that if you have your stock, you're holding your stock for at least 3 years. For at least 3 years, that's the time frame. When you sell the company to your employees, you don't have to pay capital gains tax. You can defer your capital gains tax, which is tremendous. So normally, if you sell your company, any company, for $100 million, you have to pay capital gains tax. Now, on average, the capital gains tax you get a capital gains tax federally and in the state. So across the board, it's about 30%. So if you sell your company for $100 million, you pay $30 million in capital gains. If you sold your company for $10 million, you pay $3 million in capital gains. It's a lot of money. You sell to your employees via this ESOP structure, you can defer those capital gains. And if you structure them correctly, you can defer them forever. So it's a really tremendous subsidy. Now, if you've only been in business for a year and you think you can have a lot of growth and they come to me, I would say, let's wait. Don't do it yet. It doesn't make sense. And then they'll say, well, and also, what about 280E? Doesn't matter, because with 280E, it allows me to have a conversation with people. But yeah, your effective tax rate without 280E or with 280E is 65%. With 280E, it's 45%. So yeah, you're paying less tax, but still, the idea is once you do this, you eventually become a completely tax-free entity, which is a nice big incentive. But the incentive of paying no capital gains tax for the actual owners, that's pretty huge. So that's why in certain circumstances, you need to wait.
How did you patent this ESOP methodology?
Oh, it's now I didn't patent it, it's patent pending.
Okay.
So patent pending is where you're trying to get a patent for it. To get the actual patent itself takes many years.
Okay. Is this method help with employee retention? Does it also help with employee buy-in?
Oh, it's actually huge, and there's been studies done. Once you structure your firm as this ESOP and you start explaining, they understand it, right? Think about it. You're just a worker right now. Come in, you might like your work, you get your salary, and you get a bonus maybe, and great, you go home. Well, then I tell you, you know why? You're also an owner. You're an employee owner, and you know this in your company. There's 100 employees, so by definition, you have about 1% of this company now. By definition. So, and once you start understanding it, you kind of realizing that you don't want to leave, and you start working harder. So what happens is retention in these companies increased by over 300% versus a non-ESOP owned company. And productivity on an annual basis increases by like 2-3%. And these are all documented. It's pretty amazing.
No, that is amazing, particularly when it comes to skills that, you know, a lot of these companies have issues with. Hey, I don't want to train you just so you can go somewhere else.
That's correct. And that's what happens. You know, you have these bud tenders and they're working for you for a year, and you're really putting in all your blood, sweat, and tears into teaching them. And then bye-bye. They leave because someone offers them, $2.50 more an hour. Now, if they have an ESOP and they're part of that, that's not going to make the move at all to them, because they're going to be able to see it. With an ESOP, every year, you can see the value of your account. Now, an ESOP itself, right, it's not a profit-sharing plan. You're not sharing the profits every year. That's not how it works. What happens here is it's an actual called an employee stock ownership trust, which actually owns the company, which is the sole shareholder of the company. And the employees are all beneficiaries of this trust. So if you're making, and it's non-discriminatory, it's not subjective, it's purely objective. If you make $50,000 a year and I make $100,000 a year, I'm going to end up with twice as much stock allocated to me than to you. Very, very simple. And so, again, I forgot where were we going?
In terms of like So if I'm making 50 a year and you're making $100,000 a year, in like you're saying it's not profit sharing, how it's kind of divvied up.
Oh, yeah. Thank you. Yeah. So what happens here is every year, based on the valuation of the company, every year is the value of the company, I can see how much my stock is worth. And the longer I stay in the company, the more stock is allocated to me every year. The stock allocation usually is about over a 20-year period. So if I'm there for 5 years, I'm going to be allocated 25%. If I'm there for 20 years, then my full allocation is almost there. So I am incented to stay as long as I can because I keep on getting stock allocated to me. I get the money when I retire. That's in the normal world. That's when I'd be getting my money. In the cannabis world, I think it's a little bit different. I think with the cannabis world, because the mindset of everyone is hold out till federal legalization, hold out, and that's where we get that bump up in our multiple, and that's where we can exit to, let's say, Budweiser or 7-Eleven. And that's when everyone exits at the same time. The second exit. This is called, I call it the second bite at the apple, because the owners will sell today to the ESOP. Remember that example for $100 million. But the owners, when they sell, can also get something called warrants. A warrant is like a stock option. It allows them to buy a piece of the company into the future. So they might be able to get options for 10% of the company. So they have options for 10% of the company for the owners now. Now that company, they sold it for $100 million. Great. They did really well today. 10 years from now, Budweiser comes in, wants to buy it for $1 billion. Great. This is how it works. The ESOP gets terminated. All of the employees vest automatically. There's a vesting schedule, usually it's like a 5-year schedule, but everyone vests automatically. Whatever stock you have allocated at the time, you get the stock. So now, if $1 billion comes in, the owners, the former owners of those warrants, they would get $100 million. The other $900 million goes to the employees, and it goes into the employee accounts, retirement accounts, which goes into the IRAs. They do not pay any tax on that. It can grow in their IRA until they remove it whenever they want to remove it. But when they remove it, they have to pay tax. They're not penalized, but they do pay tax on that. The owners in that second bite at the apple, that $100 million, they have to pay capital gains on that.
In the cannabis industry, one thing I hear about from operators and actually anyone at any level of the industry is how they just don't have enough time in the day, right? Because they're wearing a lot of different hats, and they just have a lot on an operational level. Is part of it that they just don't have the time to invest in executing this sort of strategy?
Oh, no, because this is not something that they would be doing. So for this strategy, it's just an M&A process. It's a big process to do it. It's not, I'm explaining and diluting it down, but the process takes, you have attorneys, you have investment banking firms, you have valuation companies. The owners themselves, they're not really doing anything. They're kind of just overseeing it. So it's not going to take tons of time out of their overseeing the world. There's a headache. It's just like in any M&A deal, except these M&A deals, this will go through. But yeah, it's an M&A deal. But you have an entire team of people who are actually doing the work. The biggest issue for us is really getting in front of people and educating this, because we think that there's a lot of people that know it. It's not. There's only a certain amount of people that listen to these podcasts and will listen to it all the way through, or read an article and go all the way through. Those people are the ones that become interested.
Mm-hmm. Hey, we have great retention on this podcast, so don't worry. They're still listening. Is the ESOP going to be your primary focus for the foreseeable future, or do you have other potential financial tools that could help mitigate other barriers?
Oh, I think I'm a pretty smart guy, so I know other things. But we specifically are ESOP advisory. That's what we do. It's ESOPs. Like I said before, we've been doing this ESOPs only for the past 25 years now. Yep. ESOPs. That's what we do. That's our small vertical in the investment banking space. So if you speak to any investment banking firm out there, they have no idea what this is, because it's such a small space. To tell you how small, there are 6,500 ESOPs right now in the entire country. There's about 250 ESOPs that are done every single year.
Wow.
That's it. 250 ESOPs done every year. And the reason why that there's not more, it's just people have no idea. I mean, I get into these, I'm always explaining how this works. And a lot of times I get, oh, I know about ESOPs. It's not right. I don't think it's right for us. I heard a lot of bad things. I know it's not really good for all situations. Okay, great. Let's go through it. What did you hear about ESOPs? Well, I know it's a pension plan. Okay. And ESOP is not a pension, so it's really, a lot of times I have to go through the myths and then explain how it actually works. We're using a pension plan. That's just only one small sliver of what you're actually doing. But yes, you are using a pension plan to make it work.
So what is MBO's role in it? Is your role finding the people looking to execute an ESOP and then basically making all the connections in terms of how to make it work?
That's right. I'm quarterbacking the entire deal, and I know how to get it. I know how to get it done. That's exactly what I'm doing. So I'm making sure that the right investment bank that's sort of been working on this is working on this. I'm making sure we have the right attorneys. If they have attorneys, great, that you already want to use, fantastic. All right, let's put you together with these guys that know how to do this piece. You have your regulatory attorneys also in this space, right? So that has to be done correctly. Maybe in certain states, you had to have a piece of legislation that needed to be put through. Well, one of our attorneys will put that legislation and try to push it through. Because there is no state, there's no Cannabis Control Commission that doesn't want to do an ESOP. It's just that they don't know what it is. And once you explain to them, and you explain how they're looking at social equity, there's nothing better than an ESOP to have broad-based social equity among all of your employees, as opposed to one lucky winner of a lottery to have them their social equity. This really is, the broad-based ownership truly works. Why make only one person rich theoretically when you can make the entire employee base rich?
That's actually a really good point in terms of messaging. Just everything that we hear regarding social equity in the industry, a lot of people feel like it's often lip service, whereas this would be a kind of a true social equity play.
Yeah, it is lip service. A lot of times with social equity, well, it's just like anything, there's loopholes. Well, okay, so I need a social equity owner. Well, what does that mean? Okay, well, that means 51%. Okay, let me find a friend of mine that fits into the minority category, and boom, all right, they're going to have 51%. And then you can figure out there's so many ways to get around the social equity applications. You're not getting around anything. With an ESOP, there is no getting around. The employees become these employee owners. So it truly does work. I'm a believer in it.
Oh, I mean, that's one thing that I definitely resonates is your passion for this type of plan. What are some of the other myths that you run into, common questions or challenges that you have from potential clients?
Let's think. Like I said, the myth that I get into from the very beginning is I heard it's really complicated. And I'm like, it's an M&A deal. If you're going to get bought out by private equity, it's complicated because you're dealing with a lot of different things. But is it any more complicated than a private equity deal? No, it's not. Another thing that I get is when people start saying to me, okay, well, I know what it is. And, it's kind of, it doesn't make sense to me. This is what they say. And it's amazing how a lot of times an attorney or an accountant at first, they kind of read stuff and they're like, well, I know what this is. So an ESOP, is an IRC section 401A qualified defined contribution plan. And it's also a stock bonus plan. It's a money purchase. And they start talking to me about what they read somewhere in the IRS code. And that's not good because to them, they see it as they fall asleep literally within 2 minutes. They don't know what they're saying. I don't know what I just told you. I know what it is, but really, no. It looks very complicated. And okay, here's another issue. I'm always wanting to be put, everyone wants to put me in, if they're not listening, oh, we're going to put you in with like the benefits, the benefit people. No, I'm not with the 401 benefit people. That's great, but that's not what this is. It's a way to sell the company. It's a financial structure. It's not that. So these are the kind of things that you're always coming up against, literally all the time. And I guess one of the biggest myths that you always get is, I heard it doesn't always work. And I'm like, yeah, I mean, companies go out of business. But that I always hear that. It's like, oh, it doesn't work. And I'm like, well, as a matter of fact, an ESOP owned company goes out of business. And I've got the statistic, like it's kind of crazy. It's almost like 30% less than any private equity owned business because you have no taxes. So you had that much more cash flow. So you're not going out of business as much as the other companies. But everyone always has heard about these companies that haven't done as well. An ESOP is in competition with private equity. That's just the bottom line. So if you're speaking to private equity people, and by the way, the entire ecosystem of the United States, the financial ecosystem is all geared towards private equity. It's not geared towards employee ownership. So if you bring on 10 investment bankers onto your podcast, they will have no idea what an ESOP is. That's not their job. Their job is to have an auction of these companies and sell it to private equity or strategic buyer, not to the employees. That's not what their job is. So no one has any idea. So they're going to say, oh yeah, an ESOP, that's complicated. It's a 401k. Oh, and they'll also say, but you're not going to get enough money for that. You won't get enough money for an ESOP. When you add in post-tax, you make a lot more money. Now, a strategic buyer can always come in and just pay whatever they want.
Yeah. When you had kind of alluded to my next question is, does it ever not work? And you're saying that it only doesn't work in the event that the company just fails.
That's right. Just like any other company. If it fails, it fails. Like for instance, I'm in the cannabis space. And let's say I am let's use New York right now as a great example. I have not spoken to anybody on Long Island, just so you know. I passed by a cannabis company. Fact. This is what's going to happen. And this is way in the middle of Long Island. This is what's going to happen. Their revenues are going to go like this and like this. So will they go out of business? I don't know. But that company, which I know because I've seen it all, they're going to go like that. So if they do an ESOP and they're right over here and the valuation is a normal valuation and they start losing money and not doing as well, they're going to go out of business, not because of the ESOP, but they're going to go out of business because maybe the price of flour will decline to a point where their profit margins are being squeezed. So, and they happen to have an ESOP in place, or they were owned by private equity, or they're owned by strategic. Regardless, they're not going to do as well.
Right now, is MBO only doing ESOPs in cannabis, or are you still doing ESOPs sort of anywhere that'll take? Yeah.
Oh, I just closed a very large automotive components manufacturer yesterday from Michigan. I closed a hot tub manufacturer in I guess late January in Tennessee. So yeah, we do everything. It just happens that in the cannabis space, I'm it.
Okay. I mean, do you see our ESOPs primarily in manufacturing?
ESOPs are primarily in the boring industries. And what is the boring industry? When you walk outside, or you're in your studio right now, and you look around, anything that you see and feel and touch, those are the boring industries, right? Like whoever manufactured this glass, let's say they're making $5 million a year, perfect, right? The people that, put in my flooring companies, the people that put this building in here, right? Construction companies. I go to try to get a job to a staffing agency. I go to my doctor, medical offices. All of these companies make great ESOPs. What doesn't make a great ESOP or high flyers, which is what I originally thought cannabis was. So artificial intelligence right now, everyone's putting artificial intelligence on their thing. They could be a manufacturer of pens, but they're artificial intelligence of manufacturer of pens, and they're getting a higher multiple for it. So everyone's getting these higher multiples. That's on their valuation. So a true artificial intelligence company could have a valuation. They could be making $1 million a year, and they could sell for 100 million. That's a multiple of 100. You're not getting that with an ESOP. Remember, an ESOP has to pay fair market value. So you're not going to be able to get this huge premium. So that's why, like I said, the staid, boring, mature companies are the best companies for ESOPs.
I understand that you probably have non-disclosure agreements with many of your clients. Are there any clients in cannabis that you can talk about, as sort of a success story so far?
Yeah, I have NDAs with everybody. So I can't talk about anybody, but we all know that Theory Wellness came out of the closet and they said that they were an ESOP. So I will come out of the closet and say, yes, that was my client.
Okay. How did things work with Theory?
Phenomenal. Yeah, it worked really well. I mean, it's pretty much as I explained it to you is how they did it. It took them, the time frame for them, and then they were the first ones to actually they were the first ESOP in the country in cannabis. I think the time frame for them was about 8 months. Those are super, super nice guys. The owners are brilliant. They were asking 1,001 questions. They really were on top of it. Phenomenal C-suite team. I can say nothing wrong about them. They really are very good, and they're very employee centric. So they really wanted to do something that was great for the employees.
Does it have the impact where will it not only give employee more buy-in to the company, but does it give them more buy-in to the company leadership? Yeah.
By definition, right? They're employee owners. So they come to the office, and I'm not sure if it's happening yet because it usually takes about a year transition in your mind. But normally you clock in at 9:30. When you're an owner, you're not clocking in at 9:30 anymore. You're coming in earlier because you want to make sure that things are aligned. You're fixing things. It does change your mindset. It just takes a little while to get to that change of mindset.
Do employees when they become an employee owner, do they have a bigger say in terms of what the company does operationally?
No. The company, just like any company, is controlled or governed. All corporations in the United States, and there's millions of them, are governed by the board of directors. If you have your own company, right, your company that you own right now, you think maybe it's your own company and you think that you're doing what you want to do. You're not. It's the board of directors who happens to be you, but it's the board of directors that is governing the company. And it's the same thing with an ESOP owned company. It's a corporation and it's governed by the board of directors. Now you codify it with an ESOP. So you really do have the board of directors. Traditionally, the board of directors that was before the ESOP was in place is going to be the same board of directors that is in place now. And there might be, in a couple of years, you might have some independent directors coming on board. And that's how the company is governed. Now, which has really nothing to do with ESOPs, there is a movement towards open book management. And more ESOPs than non-ESOPs do open book management. And that means that I have 100 employees. I'm training my employees to understand revenues, cost of goods sold, operating expenses, profits. And to me, well, I do that every day for years. So it's second nature to me. It's not something that's second nature to everybody. Most people have no idea the difference between revenue and profit. They just don't. So it takes a while to explain this. And so you're really educating, but you're opening up your books. And so in open book management, look, guys, this is what we're making. This is what you're selling. This is Joe's salary. Everyone sees everything. And they see why this person might be making more money than this person, but everyone sees it. Now, open book management takes a couple of years to get into, but supposedly it really is a phenomenal way to manage. Doesn't mean that everyone's making decisions. They're not. The board of directors is still governing everything, but open book management does help. It just takes very difficult. It's very long to do. KKR, which is the largest private equity firm in the world, is very much into open book management for certain companies.
Well, Darren, I really do appreciate you taking the time today, just because I think you're shedding a light on a part of the industry that is still very unknown. So I think it could be a very useful tool to cannabis operators out there. Is there anything that we might have missed, or anything in particular you want to make sure the cannabis equipment audience either knows about yourself or your work at MBO?
No, I think I got it. Like I said earlier, again, I'll say it, we've structured over 400 ESOPs in the past 24, 25 years. So we really do know this space super well. And every ESOP is always different. So what we do is we have to speak to the owners, go through their company, we look under the hood, and we say to them that this is a good idea, not a good idea. It's not like when you have companies, they come to me, I'm not someone that is going to be like, oh, yeah, we're doing an ESOP for everybody. It doesn't work that way. A lot of companies might be too small to do the ESOP. Like, for instance, the floor to do an ESOP would be about 2 to 2.5 million in EBITDA. That's in your net income, which is a high number. So for a lot of smaller companies that are making $500,000 a year, they're thinking of it, it's a little bit too small, because you do have a lot of expenses. Like let's say if you have 50 employees, your annual fees are, let's say, 50 grand. Well, if you're making $500,000 a year, even though you're paying no taxes, well, 50 grand, it's a lot. If you're making 2.5 million and normally going to pay 1.5 in taxes, well, the $50,000 a year is nothing.
Okay. So, there are annual fees for having an ESOP?
Yeah, because annually, you have that trustee, right? So you have a trustee that every year they're there. They come visit you. They're there. Even though they're not doing anything, they're there. The trustee gets a valuation firm, and every year there's a value of your company. So you got to pay for that. And then you also have all these forms that need to be filled out for each employee, so that, Dave, I know you get 77 shares and I get 73 shares. Someone has to do that number. So that's how it works.
Okay. You said that you've had more than 400. How many have you had to say no to?
Oh, geez. Probably 1,000. Yeah. over the years. We probably said, it's just because, again, a lot of companies are they're too small. What I do is I build up relationships, and sometimes it takes years. I had a call, I guess it was last week. It was a firm, they were doing about 25 million in EBITDA, in net income. And this is a long-term nursing care facilities out west. COVID hit, they're just doing really poorly. They couldn't get staff. They almost went under. And I always keep in touch, and now they're ready and they're back. So they'll be doing their ESOP probably by December. We'll close December of 2024.
Well, again, it sounds like you never really, think finance and excitement, but your passion for it and the opportunity in the industry, I think, really stands out. So, Darren, thank you again for taking the time today.
Yeah, I appreciate it, and thank you so much. Yeah, I'm a big believer in employee ownership. I'm an evangelist.
Yeah, no, you are definitely the advocate. Before we get out of here, please make sure to like, share, and subscribe to the podcast. You can also help us out a lot by leaving the podcast a positive review on whatever platform you use. If you want to email the podcast, you're going to reach me at david@cannabisequipmentnews.com with email the podcast in the subject line. You can also subscribe to our daily newsletter. Make sure you get it delivered to your inbox first. For Darren Gleeman, managing partner at MBO Ventures, I'm David Manti. This is the Cannabis Equipment News Podcast, and we'll see you next week.